Hi, guys, and welcome back to another episode of the Ginger Realtor Show. It is Mortgage Mondays, and we have Eric Kline from Southern Trust Mortgage. Eric, thank you very much for joining us.
Are you kidding? It's my pleasure. Glad I could be back here for my second Monday.
Okay, so let's just jump straight into it. It's been a turbulent couple of weeks in the world. I know that everything's gone up from gas prices to cost of lemons. So how are things in the mortgage industry reacting right now?
Well, this is just a weird time because this is the first war that we're involved in, but we're not involved in it. It's so strange. Most times when war comes, it's good for the economy. Everything, gets produced, military goes, taxes, et cetera, et cetera. But it's a different style of war that's going on. So actually, it's not the best thing. Our interest rates are at an all-time high since, or it's not all-time, since a high since February 2019. We have not reached this type of interest rate where it's actually an average above 4 right now. And part of that is due to the war that's going on over in Ukraine. It's affecting all of our lives.
Now, is that across the board on all products, things like FHA, conventional, VA?
Yeah, it's basically an average of all of them put together. I think it's 4.09 right now is what the average rate across the country. And that scares a lot of buyers. And everyone hears that big bad number we reach 4, but it's the world we live in right now. And I think we should just get used to it.
Look, I mean, it's not a terrible number in the grand scheme of things. I know that I've definitely sold houses to people who's been 5.5%, nearly 6% in some cases over the last 10 years. So yeah, it's not as good as it was this time last year, but it's certainly not the worst thing in the world.
It's not, don't get me wrong, you can get something below 4. I'm just doing a broad categorization out there. There's tons of programs, but 4 is considered the new norm right now.
Now, obviously, if you're looking at some of these products that we mentioned, things like the FHA mortgage, you're putting less than a full deposit down on a conventional, that 4% is going to get hit with the additional fee of PMI.
The PMI or MIP, private mortgage insurance plus monthly insurance premium, it depends on what kind you look. Private mortgage insurance through conventional, mortgage insurance premiums are through FHA. But we don't want to get hit with that, but most likely we are. And we get hit by not putting 20% down on our house.
So let's talk about why they're there.
All right. It is a sort of safeguard insurance, if you may, to the actual buyer of the loan. So we do the loan, and then after we do it, we actually put it on the open market and an investor buys the loan. If you don't put 20% down, they don't consider it you have enough skin in the game. If you need to, so in order for you to have skin in the game, they're just going to charge you an extra dollar amount. If it's a conventional loan, you can actually shop for the rate. If it's an FHA loan, that rate is set by the government. There's nothing you can do about it. But on a conventional loan, since it's a private investor, so we'll say you're 20% invested in your house, which means you owe 20 and the investor owns 80. That is a magic number. That's the marker we're going to go for, because then we can start talking about your insurance falling off. Where an FHA, you are going to pay that undetermined amount for the life of the loan.
So yeah, so I know that with my house in New Jersey, we weren't ready to buy, we weren't in a good place, but we found an amazing house. And so we took an FHA loan that had a really good interest rate. We were like 3.25, but we had PMI, and that PMI was a chunk of change. It's not cheap.
It is not. I mean, if we're looking at a high balance loan and, you're putting only 3.5% down, say it's, a $500,000 loan, it can literally be an extra $200 a month that goes towards nothing. It just goes straight into the government's pockets, the investors' pockets. It doesn't go towards interest, doesn't go towards your actual mortgage balance. It goes towards nothing but lining up their pockets.
No, I hear you on that one. And I can definitely tell you that when we got the PMI on our FHA loan, it was definitely a higher interest rate as well. So it's not like we got what you've got today, where the government has taken the time to actually bring the rate down for PMI. We had a much higher premium.
There's a little trick on that. On the FHA loan, if you just put 10% down instead of, your standard 3.5, your insurance will actually fall off after 11 years.
Well, we've had the house I mean, we just in the process of selling a New Jersey house right now, and I think in the last month or two, it's just dropped off,
Yeah,
which is
as I
great. It's
said,
an
if you
extra
put
$400
10%
in our
down,
pocket. So
it is. It's good money. It's good money. It's your car payment.
definitely. So how do we avoid PMI? Is it just a case of taking a conventional with 20% down?
There's a couple of different ways we can do this. One on the FHA, like I said, you can try just 10% down instead of 3.5, which most people do. 10% down will show that you actually do have enough money to get into the game. So they'll take it away after 11 years, which is a good thing. You know, you're not paying the other 19 years on it. Conventional, we have tons more options. I just did this recently. You know, the buyer didn't have the required 20% to put down on, I think it was a $485,000 mortgage. So what they do, they put 10% down, and then they have what they call the super single premium buyout on a conventional loans, where you can actually say on a $500,000 home, it might cost you an extra $8,000. Again, that goes towards nowhere. That goes straight into the investor's pockets. For giving that $8,000 outside of the normal, you know, closing bills, it actually takes away your mortgage insurance for the life of the loan. But I said that $8,000 or nine, whatever it's priced at that day, goes towards nothing. It's just to give them, it's like going above asking price. You pay
Okay.
8,000 and your mortgage insurance is gone.
And of course, this being the Hampton Roads area, we have a lot of military families who are buying homes in the area. The one good benefit of the VA, or one of the good benefits rather, of the VA loan scheme is there is no PMI, right?
There is zero PMI. So if you're a veteran and if you're a post 9/11 and you get veteran benefits from surviving spouses, you know, people don't like to look at them this much these days, but the veteran loan, the VA loan, is one of the best loans out there. I'm a veteran. I have it. I wouldn't change it for the world.
I got to admit, I'm not, but I love working those loans because I think as a country, America loves its servicemen and women until you've got to receive an offer on your home from them, and then you listen to the seller's agents and they're like, oh, this is not a good loan to accept. No, I think with any situation, with any loan, whether you're 3.5 FHA, you're zero down VA, or you're full 20% conventional, I think understanding and speaking with a mortgage professional on the other side of the deal to find out just how well qualified the buyer of that property or the prospective buyer is what real listing agents should be doing, rather than just taking old, outdated tropes about how different products are.
I mean, they're so worried about the appraisal coming back under, and that's a bad stereotype. It happens to every type of loan where an appraisal could come back too low, but at least the VA, there's two courses that you can take, or two recourses that you can take. If the appraisal comes low, you can actually go to the VA and you can go to the appraiser and get it redone two different ways.
But with
So
the
they
VA
actually,
appraisal, they'll come to you in advance and let you know that they're having difficulty finding the appraisal value, and you have an opportunity as a listing agent or a seller's or buyer's agent to justify that price. So
exactly, the VA is the way to go if you're a veteran or a surviving spouse, whatever it may be. It's a great loan, and you know, people, a lot of our military is getting knocked for, but these people are qualified, sometimes overqualified. We just got to get past that stigma.
yeah, so let me ask you something. We had Barrett from Loan Depot on last week, and he mentioned a couple of products that they have. And I know we spoke during the week, and we talked about the extended rate lock for somebody who may be shopping around, maybe looking around and looking to buy a house. Obviously, the VA loan comes in with the perception of being a negative loan for a seller, but not for the buyer. What are you guys doing to help out people who are finding difficulty in finding the right house?
Well, as you know, right now it is definitely a seller's market. So it's taking you a little bit more time to find that perfect home. So we have the rate lock where you can lock in your rate today and go shop, the lock and shop rate. So say you want to start looking today, we can lock in your rate for the first 45 days. And then once you actually get the contract on your house, you have 45 days to close. What's the benefit of that? Well, the Fed has already announced that there's going to be rate hikes this year. We're going to get another, three more, maybe possibly topping out at 5. So if you're looking at 90 days down the road and say you have to pay a quarter point for today's rate. So a quarter point would be literally 0.025 of the loan. So you pay the little small quarter point, which might equal 1,000 or two, but that's locking in your rate for 90 days. So if you do find that home and say the rates are up literally a half an interest point, you could save over 40 grand over the life of loan for this
And that's what I think
small
people
fee
don't
up
really
front.
realize when they're looking at because obviously it's 30 years for the mortgage for most mortgages. And people are like, okay, well, this is what I'll pay. But then when you realize and you take that dollar amount, which may not seem like a lot on a month-to-month basis, but when you pay that 360 times, it soon adds up.
It adds up to a ton more. Then you add all the interest with it. So we have that for the short-term buyers and for the long-term buyers who are getting their new construction. Let's face it, construction is not being done in 3 months anymore. There's going to be delays. There's going to be shorting orders. There's going to be staffing shortages. It's just the world we live in today. So now we have a 270-day lock and a 350-day lock, which is even better. You know, for 270 days, I think we can lock you in for just a point, 1 point, while your whole mortgage is being, or while your whole house is being done. It's a phenomenal product to use right now.
Okay, so Eric, if anyone who's watching this video wants to find more information on those products, where can they go online?
Well, if you want, I would always say just always go to my Instagram page first. Make sure we have a little thing for it, and give me a call or email me directly. I'll gladly point you in all the directions because it's going to say a whole bunch of stuff you're probably not going to understand, and I'd rather walk you through the process.
All right, guys, we will have Eric's Instagram handle underneath him by this point in the conversation, so you'll be able to go and visit his Instagram there. Eric, thank you very much for coming out and doing Mortgage Mondays with us again. We'll see you back in 2 weeks.
Yeah, and I'll see you on the golf course before then. I appreciate it.
Hopefully so. Okay, guys, that's all we have time for on the Ginger Realtor Market Mondays for this week. We'll be back next week with Barrett Ketchian from Long Depot up in Jersey City. For now, that's all we have time for. Thank you for watching.